Welcome to Bees with Rich. I'm Rich, editor of Under the Radar Report. Once again, the stars of the show are the stocks. Speaking of which, today I'm talking about some of our long-term favourite small caps: Omni Bridgeway, SRG Global, Karoon Energy, Austal, Ingenia Communities, Macquarie Telecom. The last one we picked several times below $10, took profits at $80. That's what I'm talking about. Let's crack it. Literally, people, talk is cheap. Oh, it's not bad. Creamy. As inflation ramps up, you might be wondering what to do. And yes, as I said before, talk is cheap. Investors are hunting for certainty in the form of near-term profitability in the stock market, and that's what they're finding. That's why there's so much takeover activity. In a nutshell, also, that's why we're advocating building up a portfolio by buying a number of stocks in small chunks. So there's no indicator that says, here's value, there's a switch to value right now. It occurs over time, but clearly, the stock returns we're getting indicate that we're right in the middle of a value of a stock picking market. So what does hunting for value mean? I'm sure you're asking that. Well, if I was to distill the philosophy in one sentence, it would be: show me a great business, sure, but I'll only buy it at the right price. And that pretty much sums it up. Growth is fine. In fact, it's good. But it all depends on what you're paying for that growth. When investors pay too much for it, like we had that situation occur over a period of time where people were just paying up for growth willy-nilly, not looking at the bottom line, then eventually when the music stops and you get earnings downgrades, bang, you also get multiple downgrades. So they get that double whammy. That's why value drives growth over the long term. I mean, that's proven in all the studies. Basically, with value, you get the double whammy on the opposite side. You get the chance to get not only an earnings uplift, but also a multiple uplift. That's the double whammy. But that's what we're here to talk about, is stocks. And let me just start with Omni Bridgeway. Not a simple stock. In fact, it's been around for a while. It's a world leader in litigation funding, an Australian company. You heard about it under the radar report, but it's been a tough road as they've transitioned from fully funding class actions to part funding them. So it's been a bumpy road, and litigation is a bumpy road in terms of profitability. But like the stocks coming good, spiked 11% on the result, 50% over 2 months. Profits are lumpy, as I said, but what's less lumpy, and what I think is the key to this stock, is its return on equity. Its return on equity has gone from 20+% to 30% as they've improved their business model, and that's the key. That's the key to all these companies. Another company, SRG Global, well, it's really improved its return on equity from 4 to 6% to 6 to 8%. It might not sound like much, but basically the company's been de-risked. So it went from being a scaffolding company, contractor in WA, to being a much broader business. So basically, but it's a better business and it's getting better profits, but it's still got a bit of that contracting sort of scaffolding feel to it, family-run business, and that's why it's still under the radar. So we still think it's good value. But what happens over time with these sort of companies, when they consistently improve profitability, the big funds can't ignore it. They have to own it. Basically, field of dream stuff, build it and they come, and those funds come, and that's where you get your re-rating from. That's the under the radar philosophy. The one that probably epitomizes it even better is Macquarie Telecom. I mean, we got an 8-fold increase in that stock, but it's been a bumpy ride. Basically, it's 60% held by the Tudor Hope brothers. So they've got an iron control over this company. So that means that they don't issue much equity, in fact, no equity. They've just, so sometimes there is a debt, they have ridden the debt cycle well to build up that big portfolio of data centers. And they've had a vision, and guess what? They've delivered on that vision without raising equity, and that's impressive. And so, and that's what happens. This company, they were complaining to me, oh, why don't fund managers come to us? And I said, like, if you keep performing how you're performing, they'll come. Just keep performing. And that's what they did. And that's what drove growth there. So with these companies, what you have is a compounding effect. When you have a smaller asset base and your returns are strong on that asset base, you get a compounding effect, and that's what really drives profitability. That's what drives the big returns from small cap. So what's coming up? Next week we're covering another 10 or more stocks, so there's going to be some opportunities there. And we also rank the nuclear stocks in order of our preference, plus we cover a new one. That's right, a new nuclear stock. Why do we like uranium nuclear as a theme, you might ask? So the world's running out of options to cut emissions, to put it simply. Nuclear is the only option really when it comes to baseload power. Long term in Asia, Europe and the US, nuclear energy will be a part of the solution. Certainly Japan's decision last week to potentially bring online 33 reactors in the next 24 months indicates this. The beer! Finally we get to it. Talk is cheap. I've shown it to you. I think it's an oat cream IPA, Range Brewing, Brisbane, Queensland, where I hear property prices are sliding. So get into those stocks, people of Queensland. In final is that drinking beer and investing can deliver good returns, but I would bank more on investing. Here's to Beers was Rich.